Innovation China is an annual conference that brings together startups, multinational companies, and investors to discuss latest innovations and showcase most exciting startups.
Good morning. The title of my speech is Investing in Materials. So actually, when I arrived in Tsinghua University in 1988, fully expecting to go to the chemistry department, I was told that Tsinghua formed a new department called the Department of Material Science, and I would be in it. So from 1988, after spending 9 years studying material science, including doing a doctorate at the University of Southern California, and then spending further 6 years actually practicing it in the lab, developing materials and products, and then spending 15 years looking at investing in material science. I would say that after 30 years, actually the more you are in the field, the more humble you become. I feel like the only true wisdom is really knowing that you know nothing in this. I and many of my peers who are investing in materials are still pondering, how do we do this better? How do we do this very effectively? So why is it so hard to invest in materials versus other industries? Because for most materials companies, their financial look like that. So you have a price over sales around 1 to 2, and you have a profit margin, operating margin between 10 and 20%, and you end up with a profit margin again around 10%. While if we compare to the IT companies, we are looking at price over sales of 5 to 10. We are looking at a profit margin of north of 25% to 50% even. So compared to Facebook and Apple, do we have a hope investing in this very challenging field? But, so I was thinking, how do I give this talk? Are there materials companies that are also valued highly? So I actually went back to study this field of materials companies. So here is one company that is in materials with a price of sales of 20 and the operating margin of 32%. Can anyone guess which material company is that? It's probably very difficult to guess. And it's actually called the Universal Display Corporation, so UDC. In Chinese, it's 通用显示材料公司. So what does it do to have a price of sales of 20? So this is from their investor presentation, literally how they describe what they do. So UDC is literally a critical OLED innovator in Asia. They sell OLED materials. They are the leading supplier of OLED materials. And it has 3,000 patents. And it literally derives half its revenue from the patent licensing. So if you look at the revenue stage in 2017, the royalty is 127 million, while the product sales is 198 million. So what does the company say as why they are valued so much? What are their strengths? A, it's clear OLED leader. B, it has very big leading customers. So Samsung, LG Display, all the big display companies are their customers or their licensees. It has very robust IP, like I said, 3,000 patents, and it has really strong financials. So it has never had a debt. And amazingly, this company never raised a single dollar of venture capital money from its very beginning of spinning out of university. So there's another company that also has a very good profit margin, operating margin of 30%, has a good market valuation, and it's Versum Materials. So what does Versum Material do then? It solidly describes itself as a semiconductor material in the electronic material industry. And how do they describe their value? They have 4 quarters as well. Top is customer relationship. Then they talk about innovation capability and IP, global supply chain, and a diversified portfolio. So if you take these material companies who are highly valued by the market and you summarize what do they have in common. So what really works for materials? So first of all, I think it's a leading position in a fast-growing industry. You really want to be a dominant player in a field that is fast-growing, and that's what's common for these companies. Second is high-quality customer and strong customer relationship. So what I mean, high-quality customers, they are leading players in the industry. They have good reputation. They have good payment terms. They are not delaying payments. And they have a strong innovation capabilities themselves. The third is innovation capability and intellectual property. So you cannot possibly be highly valued if you don't have innovation capability, if you can continue to innovate and you have very strong IP portfolio. And you have a strong financial. So I would say for materials company, a gross margin of north of 50% is probably desired or needed in order to have high, good growth and good, strong financial. So in summary, leadership position in a high growth industry, I think that's really number one. You've got to be able to summarize your company in one sentence to say what are you leader at. High quality customers and customer relationship. So that's also very important. Only if the company has customers can company have continued strong financial and to have innovation capability. So what to avoid? We just talked about what works for high-value material company. What to avoid? So I think I talked with my partners. I think our view is that the number one thing is really don't invest too early, because capital cannot accelerate market adoption. It's not if you don't have a customer, if you don't have market. Even if you raise a ton of money, it's not going to help you to get into the market. So talking about UDC, so the one that we're looking at the price of sales of 20 back then, this is the chart. So UDC founded in 1994, went listed on public NASDAQ in 1996, but looking at its market value, it really only started rising in the 2012 range. So that's literally last 10 years it has been rising. And why? Because OLED as an industry, as a technology, took 30 years to get to the mainstream. So if you invested too early, and if you are VC fund with 10-year life cycle, basically you might be still in the very beginning of finding market by the time you needed to exit. So there was a paper in the US literature about a financial model explaining why nanotech struggles. I think nanotech is a good representation of material science. And it gives a model to say that in this field, for the faster company, it takes average 3 years in R&D and 15 years to actually reach $30 million in revenue. So that's like total 18 years. And for the average company, it might take 20 years. So it's very, very common for materials company to take 10, 20 years to mature. And there is really no need for VCs to invest in too early or companies to raise capital too early unless the market is ready. I'm sure we have seen many VC money wasted in investing too early and then by year 10 needed to sell those companies. So since the second thing to avoid, we really think, and it's very peculiar to China market, is don't race to the bottom. Because a lot of the Chinese industry and companies have a fierce price competition and they compress margin. So we, the Chinese industries have, unfortunately, many of them have price competition that really makes life miserable for all the people or players inside. So when you think of a gross margin of 10% difference, you would think, okay, it's only 10% difference. But in fact, 10% gross margin more allow you to spend 5% more on R&D, thus increase your innovation and IP. It also, the market tends to give you a higher price for your company, higher PE. So in fact, a 10% margin difference often means market value of 2x or 3x difference. So that's why it's extremely important that we look at industries and startup companies don't be in the industry where you are always looking, how do I do it cheaper, how do I compress my margin, how do I just win competition by having lower price. Then the third is to really don't chase mature or sunset industry. So I think it's much better in a high growth industry where rising tide can lift all boats. So recently we met an entrepreneur who has invented a better oil pump. I have to say it is really truly much better oil pump. But I was telling him, even the oil companies are these days all about renewable energy or about digital. When we talk to Shell and so on and so forth, nobody is interested in another better oil pump. So that makes it challenging for VCs to invest in it, and also challenging for the startup to attract any attention. So I would say for the people in the audience who are trying to build a company, it's much better to look at what's the high growth new industry that you want to be in. And the last one is to avoid unsustainable innovation, what we call one trick pony can't win. We have some Chinese companies who got one product or developed one solution that they tried and error, they have got it by luck or by something else. But if you look at the bench of R&D, it's really, you worry, where is the continuous innovation coming from? So I think for those companies, it's critical that they build R&D pipeline. So don't invest too early. Don't get into price war, low margin industry. Don't chase a sunset industry or flat industry. Those are much better left for large companies. And don't avoid unsustainable innovation. So what are we excited about at China Materialia and CM Partners? What are we excited about today? So we are excited about semiconductor, because we expect the number of digital devices go rapidly. It's going to have exponential growth and demand on semiconductor. We are interested in display because the number of screen is continuously going up. So this morning we have 4 talks in the display area, and including one of our portfolio company, Cambridge Touch Display. We'll talk about their newest Ultra Touch technology. We are interested about batteries. We have spent months studying the battery sector, and we're in the middle of closing a deal in the battery material space. And we are very excited about connectivity. So the 5G and the rollout of 5G and the future, more and more IoT connectivity. So in this field, we already invested in a Shanghai company, Promtech, Shengzhi Guangdian, and that will benefits from the 5G connectivity growth. So in the last 2 minutes, I want to just share my view on China versus the West. So overall, I think China definitely leads in terms of the speed. So time to revenue, time to product, we are doing much better. In terms of margin and IP, we are worse than the Western companies. And in terms of customer, I think we are average even. Everybody talks about China has big market and China's one big market. But in fact, I think a lot of the times you are in China market, your customers, your margin is low, your payment terms is not good. So I'm not so sure whether China leads the edge in terms of customer for many of the high-tech companies that we found. So a lot of our portfolio companies actually start by working with multinational companies or exporting before they address the China market. So at CM Partners, we are really about introducing Western mindset, Western best practices, and we help our Chinese entrepreneurs to charge full speed at the Chinese speed. We think that if we can do it the fast way, like in China does well, and we combine what's the best, the Western mindset and practice has to offer, we have an opportunity to really make investment in material science work. So hopefully that's my talk. Thank you.